Okay, here's a question. Can a company right at the forefront of healthy aging, I mean, with a patented molecule that might extend human health span, actually deliver durable long-term value for investors? Or, do its current market challenges maybe suggest a bit more caution? Today, we're taking a stack of sources on Niagen Bioscience, Inc. That's ticker symbol AG. They used to be called Chromadex Corporation. Our mission for this deep dive really is to pull out the most important nuggets of knowledge, the key insights, and give you a shortcut to being genuinely well informed about this fascinating company. It's right at the epicenter of the healthy aging revolution. And hey, speaking of Niagen Bioscience, definitely stay tuned. For our Stock Analytics AI members, we are going to be covering their earnings releases literally within minutes of them hitting the wire. So you'll get real-time analysis from us.
Yeah, in this deep dive, it's really about helping you understand their core business, its financial health, how the market sees it, and importantly, the risks and opportunities ahead. We want to help you connect the dots, between the science and the actual investment potential of a company like NHGE. Just so you know, all the data we're using today is current as of August 8th, 2025. NEGE common stock closed at $9.40 per share then.
Right. And a quick note, this deep dive was actually inspired by one of our valued Stock Analytics AI members. So remember, please like and subscribe to the Stock Analytics AI YouTube channel. It's just $4.99 a month. And members get priority deep dives on specific tickers. Over the next few months, we are covering all of the S&P 500 stocks. Members get exclusive priority access. And if you just want a one-off deep dive on something specific, just drop us a super thanks. Okay, let's unpack this. Chapter 1, business analysis. So to start, let's talk about who this company is. Niagen Bioscience, Inc., ticker NEGE. They're kind of the new kid on the block, name-wise anyway. Officially rebranded March 19, 2025. Before that, they were Chromadex Corporation, CDXC. So what's the deal with the name change? Is there like a strategic reason behind it? How does it tie into what they actually do?
That's a really good place to start. This wasn't just, slap a new label on the tin. The shift from Chromadex to Niagen Bioscience, it tells us they're really doubling down on their core patented molecule, Niagen. It signals a much clearer focus on the science itself and maybe broader applications beyond just supplements. It's a deliberate move, I think, to boost their scientific credibility, to position themselves as a serious player in, bioscience.
Right. So it's a statement of intent. Makes sense.
Yeah.
And they seem to have a pretty sophisticated business model, multiple channels. Can you walk us through those main segments, how they make their money?
Absolutely. They basically have three main pillars. First up is consumer products. This is mostly direct-to-consumer, D2C, through their big brand, Niagen, sold mainly on their own website, troniagen.com, and also Amazon. Now, what's really important here is the growth. It's been robust. Q2 2025 e-commerce net sales hit $18.1 million. That's a fantastic 39% jump year over year.
Wow, 39%.
Yeah, and the key insight is that DTC gives them, higher gross margins and really valuable direct control over customer data. Yeah. Helps build a loyal base,
Okay, so building that direct customer relationship. Got it. What's the second part?
The second is ingredients. This is their B2B, business-to-business segment. Here they supply their patented Niagen, that's nicotinamide, riboside, the actual molecule, as a raw ingredient to other companies. And this segment, it's just exploding. A 135% year-over-year increase, up to $7.4 million in Q2 2025.
Whoa, 135%.
I know, right? And that growth is coming from both their standard food-grade version and, interestingly, a new higher-value pharmaceutical-grade version. So it shows they're diversifying and kind of climbing the value chain, even within B2B.
Remarkable growth there. Okay, and the third pillar, you mentioned something new, kind of an interesting direction.
That's the pharmaceutical-grade solutions segment. This is their Niagen Plus line. It offers IV and injectable forms of Niagen. These are available by prescription through, get this, over 800 wellness clinics now.
Yeah.
And they're compounded by FDA-registered 503B facilities. Now, for you listening, 503B facilities are basically specialized pharmacies. They can compound large batches of sterile drugs, but under strict FDA oversight. So high quality, high safety.
Okay.
This is clearly a strategic push, right? Directly into the clinical medical market. So the big picture is their whole portfolio, from the supplements you buy online to the ingredients they sell B2B and these new clinical formulations. It's all built on NAD plus science.
NAD plus science.
Yeah.
Okay, for anyone listening who isn't familiar, what exactly is NAD plus plus and why is it so core to what Niagen does?
Right. NAD plus it stands for nicotinamide adenine dinucleotide. It's a vital coenzyme. It's in every single cell in your body. Think of it like cellular fuel. It powers hundreds of essential processes, energy production, DNA repair, you name it. The thing is, As we age, our NAD+ levels naturally drop, and that decline contributes to various, well, age-related issues. So Niagen Bioscience's core value proposition, their whole pitch is to improve Healthspan, the years you live in good health, by restoring and optimizing these crucial NAD+ levels, basically fighting that age-related decline.
Okay, targeting the very essence of healthy aging. That makes sense. So given that focus, where do they actually sit in the broader market landscape?
Well, they've definitely carved out a niche as the global leader in NAD+ research and technology. They've got a market cap around $730 million, give or take. And significantly, they're now included in the U.S. Small Cap Russell 2000 Index. That's a big deal.
Yeah, it is.
This puts them right at the intersection of several huge growth markets. I mean, the NAD+ market itself, over $488 million back in 2021, projected to grow, like 13% compounded annually through 2030. And the anti-aging market, even bigger, $73 billion in 2024, could hit $141 billion by 2034. The drivers are pretty clear, right? Aging population, big shift toward preventative health, biotech advances. Oh, and Asia-Pacific is a major growth driver, too.
That's a massive potential market. But I guess with that kind of potential, you get competition, right?
Oh, absolutely. It's dynamic. In the direct NAD+ supplement space, they're up against folks like Thorne Research, Renew by Science. And as they push more into pharmaceutical-grade stuff, they'll be compared more to broader life sciences companies. Now, what's really crucial to grasp here is the regulatory environment. Their main product, True Niagen, the supplement, it's regulated under DSHEA. That's the Dietary Supplement Health and Education Act. Essentially, the FDA treats it more like a food than a drug. The manufacturer, Niagen, is primarily responsible for safety. And importantly, they're restricted in the claims they can make. Only structure function claims, not disease treatment claims.
That's a really important distinction. But you mentioned they're also going down a different path, a more rigorous one for some products.
Exactly. And this is where their strategy gets really interesting, I think. They've actually received orphan drug and rare pediatric disease designations from the FDA. That's for using nicotinamide riboside to treat ataxia-telangiectasia. Plus, they're pursuing an investigational new drug, an IND application.
Yeah.
This move, along with the name change we talked about, it clearly signals they want to de-risk their identity, shift from being just a supplement company towards being seen as a biotech company. It really opens up potentially huge high-value markets.
Okay. And when it comes to defending their position, what kind of barriers to entry do they have? Is it really like a fortress around their science?
In a lot of ways, yeah. They have a pretty formidable moat, actually.
Mm-hmm.
Their IP, their intellectual property, includes over 50 owned or licensed patents globally. And they just strengthened that recently with a new patent for NR salt forms. But it's more than just patents. The scientific validation is immense. We're talking over 35 human clinical studies, 400+ total scientific studies, collaborations with over 300 research groups globally.
Wow.
That body of evidence. It's incredibly expensive. It takes a long time for anyone new to even try and replicate. Plus, True Niagen already has strong brand equity. It's the #1 NAD+ supplement in U.S. e-commerce.
So the competitive advantages aren't just the patents then. What are the key takeaways here? What makes them stand out?
Yeah, their key strengths are pretty clear. Strong brand leadership with True Niagen, for sure. Consistently expanding gross margins, hitting an impressive 65% in Q2 2025. That points to real economies of scale and pricing power.
Right.
Their B2B and clinical channels also create stickier customer bases, higher switching costs for those partners. And fundamentally, their unique assets are that scientific leadership, the huge IP portfolio, and these sophisticated regulatory capabilities. That lets them play effectively in both the supplement and the pharmaceutical arenas. And that sets us up nicely, actually, for Chapter 2, management evaluation. When you look at the leadership team, it's a really compelling story. It's this mix of scientific vision and commercial execution. Robert Fried, he's been CEO since April 2018. He has this fascinating, sort of unconventional background. A film producer, actually won an Academy Award and an Emmy Media Tech Entrepreneur.
Really? Okay.
Yeah. His arrival was pivotal. He founded the company, Healthspan Research, that launched the True Niagen brand. And his leadership has really been key in guiding Niagen from, history of losses to sustained profitability and positive cash flow.
So he's the commercial guy turning the science into something marketable. Who's the science visionary behind it all then?
That would be Frank L. Jacks Jr. He's the co-founder and currently the chairman of the board. He actually founded Chromadex way back in 1999 and was CEO until 2018. His deep background in chemistry and biology, that provided the foundational scientific vision. He was instrumental in licensing the key patents for nicotinamide riboside. So you see this powerful synergy, right? Yagsh's deep scientific credibility paired with Fried's aggressive commercial executions, kind of a classic story. Entrepreneur unlocking the market potential of scientific breakthroughs.
That dual leadership, yeah, that sounds like a real asset. How open are they? Transparent with investors, the public?
Well, being publicly traded, they stick to the required standards.
Right.
Regular financial updates, earnings calls, press releases for big news like trial results or new patents. And their ethical reputation, it was really put to the test during a long, drawn-out legal battle with a competitor, Elysium Health.
Oh, I remember hearing about that.
Yeah, they successfully resolved it, defended their IP in the end, so they've shown they're willing and able to defend what they've built.
That's good to know. Okay, let's talk money, how they spend it, capital allocation. What does their strategy there tell us about what they prioritize?
Their strategy is crystal clear.
Mm.
Aggressive reinvestment right back into the core business. You see significant spending on R&D. That includes funding a big phase 3 trial called No Park for Parkinson's disease, plus research into other areas like Werner syndrome and long COVID. They're also pouring money into sales and marketing to build that True Niagen brand and expand the Niagen Plus clinic network. And of course, scaling up operations, even increasing inventory to keep up with demand.
Are they buying other companies to grow, or is it mostly internal investment?
It's a mix, actually. They've used M&A strategically. Back in 2017, they acquired Healthspan Research that was transformative. It gave them their D2C strategy and, well, their current CEO.
Right, founder.
Exactly. More recently, they've been using licensing deals, like one with Auckland University Hospital in Norway that secured IP and clinical data related to Parkinson's. It's a pretty capital-efficient way to boost their pharma pipeline.
Okay, so lots of reinvestment. What does that mean for shareholders directly? Are they getting dividends, buybacks?
That's an important point. Currently, no dividends. And no share buybacks either. Now, this isn't necessarily a negative. It's a very deliberate capital allocation choice. Management clearly believes, and honestly, the numbers seem to back this up, that keeping 100% of earnings and cash flow to reinvest in these high-growth initiatives will generate a better long-term return for shareholders than paying out dividends now. They're playing the long game, betting on growth.
And you said the numbers back it up. Is there one key metric that really shows how effective management has been with that reinvested capital?
Absolutely. The single most powerful metric here is their return on invested capital, or ROIC. It stands at an exceptionally strong 24.35%. Now, this isn't just some abstract number. Think of it as management's report card on how well they invest. It tells you they're not just growing, they're growing profitably. For every $100 of capital they invest, they're generating $24.35 in after-tax operating profit each year.
That's impressive.
It really is. That return is way higher than their cost of capital, proving that every dollar they plow back into the business is creating substantial economic value for you, the shareholder.
Yeah.
That's pretty rare, and it strongly validates their aggressive reinvestment strategy.
Okay, this is where it gets really interesting. Let's turn to Chapter 3. Financial analysis. Time to talk numbers, starting with size. As of August 8th, 2025, their market cap was sitting around $730.2 million. Puts them squarely in the small cap space. Now, revenue growth. The really striking insight here isn't just that they're growing, it's that the growth is accelerating. I mean, they grew 7% in 2022, then jumped to 16% in 2023, then 19% in 2024. Okay, good. But the big takeaway, their trailing 12 months revenue as of Q2 2025 hit $116.3 million. That represents a fantastic 29.77% year-over-year growth. And management clearly feels confident because they raised their full year 2025 revenue growth guidance to between 22% and 27%. That jump to nearly 30% growth, it really signals a fundamental shift, maybe a market inflection point.
Right, and this acceleration isn't coming at the cost of profit, so their gross margin is consistently improved, reached an impressive 65.0% in Q2 2025.
65%.
Yeah, shows incredible efficiency and likely pricing power. Their operating margin for the trailing 12 months now a solid 14.23%. So the core business is generating healthy profits. And here's a critical shift. They actually hit net profitability for the first time in fiscal year 2024. They went from a net loss of $4.9 million in 2023 to a net income of $8.6 million in 2024. Their TTM net profit margin is 13.07%. This is a huge milestone for a company that, for years, was focused on investing heavily in R&D and getting into the market.
That pivot to profitability, yeah, that's a game changer. But maybe the most compelling financial story here is their free cash flow. For years, like many growing biotechs, they burned through cash, but that trend has totally decisively reversed. They went from burning $15 million in 2022 to generating positive free cash flow of $7 million in 2023, then $12.1 million in 2024, and already $9.1 million just in the first half of 2025. This dramatic shift, it fundamentally de-risks the whole investment thesis. It makes them financially resilient, a self-funding growth story.
And speaking of resilience, their balance sheet looks like a fortress. Now, okay, their earnings consistency is new, only really started in FY24, so there's no long track record yet. But their debt situation, virtually non-existent. They have no debt to speak of. Debt to equity is incredibly low, 0.06, mostly just for minor leases. This gives them huge financial flexibility. And their current ratio, also exceptionally strong, 3.66 into Q2 2025. Means they have $3.66 in liquid assets for every dollar of short-term bills.
Okay, so fast growth, profitable, generating cash, sitting on cash, no debt, sounds amazing. But what does that mean for the valuation? Is this already priced in? Are investors paying a premium?
Oh, they absolutely are. Niagen Bioscience definitely trades at a premium valuation. Their PE ratio, price to earnings, was sitting around 54 in late July 2025. That's certainly on the higher side compared to many companies. For example, Exelixis was around 21, though it's similar to some others, like Niagen Pharmaceuticals at 55. What this really tells us is that investors are already pricing in a lot of future growth. Their price-to-sales ratio, also pretty high at 6.38, confirms this. You're definitely paying for future potential, not just today's results.
So how do we even try to quantify that potential? You use a discounted cash flow model, a DCF. Can you briefly explain what that is and, what is suggested about Niagen?
Sure. A DCF model basically tries to estimate a company's intrinsic value, what it's really worth, by projecting all the future cash it's expected to generate and then discounting that cash back to its value today. Based on our educational DCF model, the estimated intrinsic value for Niagen Bioscience fell somewhere in the range of $10 to $14 per share. Now, super important reminder, this is an educational estimate, okay, not investment advice. And DCF models are very sensitive to the assumptions you plug in.
Right, assumptions are key. What were the main ones you built into that model?
Okay, so for revenue growth, we use a three-stage approach. 20% annually for the first 5 years, then slowing to 12% for years 6 through 10, and finally a 3.0% terminal growth rate forever after that. We projected their operating margins would expand from the current roughly 14% up to 20% over 10 years, reflecting better scale as they grow. And for the discount rate, the WACC, weighted average cost of capital, which is basically the return the company needs to earn to satisfy its investors, we use 10.0%. That rate reflects the higher risk of a small-cap, high-growth company, but it's also tempered a bit by their really strong debt-free balance sheet, which lowers the risk profile. Now, what's really fascinating is how the market is reacting to all this, which brings us neatly to Chapter 4. Market sentiment, Wall Street analysts. Overwhelmingly positive on Niagen Bioscience. The consensus rating is pretty much a strong buy or buy everywhere you look. No hold or sell recommendations, which is notable. Their average one-year price target is $14.90. That represents pretty significant potential upside, about 58.5% from the current $9.40 share price. Though granted, individual targets vary quite a bit, from $9.60 all the way up to $24.15.
That's a really strong consensus from analysts. What about recent news? Has anything happened lately that's shifted how people see the stock?
Yeah, recent news has been mostly positive. The biggest splash was probably their Q2 2025 earnings report back on August 6th. It was a significant beat revenue, up 37%. EPS doubled what analysts expected. That immediately pushed the stock up about 2.6% in after-hours trading.
Okay.
Other positive news includes things like expanding their Niagen Plus clinical network to over 800 locations now, and reports of encouraging progress in their big Parkinson's trial. The general media narrative seems to really focus on that shift to profitability and their leadership position in healthy aging.
So sounds like the financials and the headlines are generally pointing up, but what about more technical market stuff? Is there any negativity, any bearish sentiment lurking?
Well, while the overall vibe is bullish, there is some short interest. About 3.49 million shares were held short. Now, that's not extreme, but it does indicate some notable bearish bets out there, probably tied to that high valuation we discussed or maybe concerns about competition. Now, technically speaking, the stock price is currently trading 19.75% below its 50-day moving average. That suggests a short-term downtrend, or maybe just consolidation after a run-up. However, and this is key, it's simultaneously trading 19.46% above its 200-day moving average. That indicates a strong, positive, long-term uptrend.
Huh. Interesting divergence.
Yeah, it is. It could mean the stock had a quick surge and is now just catching its breath. This kind of setup could potentially offer an attractive entry point for long-term investors, assuming the underlying fundamentals keep looking good.
Okay, so who actually owns this company? Let's move to Chapter 5, ownership structure. It looks like Niagen Bioscience has attracted quite a bit of institutional money. As of early 2025, there were 273 institutional owners holding over 28 million shares. That includes big names like BlackRock, Vanguard, but also active managers like Titan Capital Management. And you mentioned earlier their inclusion in the Russell 2000 index. That also brings in a lot of passive institutional investment, which is a pretty big validation.
Exactly. And it's not just the big funds. Insiders also have significant skin in the game, as they say. The CEO, Robert Fried, for instance, owns roughly 1,580,000 shares. That's worth over $15 million. And he even made an open market purchase back in May 2023, which is usually seen as a strong signal of confidence.
Yeah, definitely.
Now, there have been some modest net sales by insiders over the last 18 months or so, but that's often just for personal financial planning, taxes, diversification. Doesn't necessarily mean they have a negative outlook on the company itself.
So leadership has a big personal stake. How concentrated is the ownership overall? Is there any single group that holds too much power?
Fortunately, no. It's actually relatively spread out. The top 13 largest shareholders together own about 51%. And the general public holds a pretty significant chunk too, around 34%. This kind of balanced structure is generally seen as a good thing for minority shareholders. It helps promote good corporate governance and prevents any single entity from having way too much control. Creates a stable foundation, which long-term investors usually like to see. Okay, if we pull all this together, it naturally leads to the question, what are the risks? Which brings us to Chapter 6, Risk Assessment. A SWOT analysis, strengths, weaknesses, opportunities, threats, gives us a good, balanced overview. Their strengths are pretty clear by now. Scientific leadership, that strong IP moat with 50-plus patents and all those human studies, the true Niagen brand being number one, that fortress balance sheet, $60.5 million cash, no debt, and a proven management team.
Those are definitely strong points, but let's be real. For a company like this, what's the single biggest vulnerability? The Achilles heel, maybe? The one thing that could really throw a wrench in the works?
That's a crucial question. I'd say the biggest weakness is their product concentration. Their success hinges almost entirely on that one core ingredient, Niagen. If anything unforeseen crops up related to that specific molecule, it could be, well, an existential threat. Also, while they're profitable now, they do have that history of losses. So no long track record of consistent earnings just yet. And their D2C business relies pretty heavily on ongoing, effective marketing spend.
Right, that single point of failure is definitely something to watch. But flip side, where are the biggest opportunities for them to really break out?
The biggest potential upside, without a doubt, is in pharmaceutical development, particularly that Phase 3 Parkinson's trial. If that succeeds, it could unlock a massively larger, higher margin market. It would completely change how the company is valued.
A game changer.
Absolutely. Beyond that, they benefit from those huge secular growth trends in anti-aging, and they still have plenty of room for international expansion and growing that Niagen Plus clinic network.
And what about the threats lurking out there? Competition, external factors?
Well, the NAD plus supplement market is definitely getting crowded. That brings intense competition, which could lead to price pressure or force them to spend even more on marketing. There's also regulatory risk. The FDA could potentially get stricter with dietary supplements, maybe something like mandatory pre-market listing. That could add significant hurdles and costs to their core business. And critically, there's the risk of adverse scientific findings. If any future large-scale trial shows negative side effects or definitively proves nicotinamide riboside doesn't work for something major, that would be catastrophic. It undermines their core product and credibility. Then you have macroeconomic factors. Inflation could bump up their raw material costs, squeezing those nice gross margins if they can't pass the cost along. Rising interest rates, while not directly hitting them via debt, do increase the discount rate used in valuations, which can pressure the stock price. Plus, higher rates can sometimes dampen consumer spending on premium health products. And finally, geopolitics. Think hypothetical U.S.-imposed tariffs in 2025. If key ingredients come from targeted countries, that could raise their costs, forcing them to either absorb the hit or raise prices.
Okay, let's wrap this all up. Chapter 7, Conclusion. Let's synthesize everything, starting with the bull case. What are the main reasons to be optimistic? I see 4 main pillars. First, market leadership in a really high-growth category. Niagen Bioscience is arguably the leader in NAD+ science. It's scientifically validated, patent-protected, and riding these huge demographic tailwinds in healthy aging. Second, that proven financial inflection point. They've successfully made the leap from burning cash in R&D to being a profitable, self-funding growth company. You see it in the accelerating revenue, the expanding margins, the positive net income, strong free cash flow, and zero debt. Third, there's significant pharmaceutical optionality. Those ongoing clinical trials, especially the big phase 3 Parkinson's study, represent a massive potential upside catalyst. A win there could completely re-rate the company as a true biotech, something maybe not fully priced in today. And fourth, you've got aligned and effective management. Now, leadership has shown they can execute strategically. They own a lot of stock themselves, aligning their interests with shareholders, and their capital allocation choices look smart, validated by that really high ROIC.
Okay, but let's balance that. It raises the important question for you listening. What's the bear case? What are the counter-arguments? First, that premium valuation. The high PE ratio means the market is already expecting a lot of growth. There's very little room for error. Any misstep could hit the stock hard. Second, the product concentration risk we talked about. The company's entire fortune rests almost solely on that one ingredient, Niagen. Any unforeseen problem there is a massive risk. Third, competitive and regulatory threats. The NAD+ market is crowded. Price competition could increase, marketing costs could rise, and the regulatory environment for supplements is always a bit uncertain. Stricter rules are always possible. And finally, there's the binary risk of that pharmaceutical development. Clinical trials are inherently risky and expensive. They fail more often than they succeed. A negative outcome in that key Parkinson's trial wouldn't just remove the upside catalyst, it could actually damage consumer perception of their core supplement business too. So, wrapping up the valuation picture. Our educational DCF model suggested an intrinsic value range between $10.50 and $14 per share. As of today, August 8, 2025, the share price is $9.40. That's trading below the low end of our estimated range. So the current market price appears to maybe not fully reflect the company's growth, its recent profitability improvements, and that significant long-term potential from the pharma pipeline. However, and this is crucial, you absolutely must weigh that potential valuation gap against the very real risks we just outlined. The high expectations baked in, the reliance on the single ingredient, and the make-or-break nature of those future clinical trial results.
So here's a final thought to leave you with. As the science of healthy aging keeps unlocking the mysteries of, cellular repair and longevity, what's really going to define success for companies like Niagen Bioscience decades from now? Is the ultimate value going to be in the consumer market or the clinical application, or is it that potentially groundbreaking pharmaceutical breakthrough? And how do you, as an investor, navigate a future that looks so multifaceted? Hey, don't forget, like and subscribe to the Stock Analytics AI YouTube channel. For just €4.99 a month, members get priority deep dives on tickers. We're covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access. And if you just want a one-off deep dive, drop us a super thanks. We appreciate it.
And just a reminder, this analysis was generated by an AI system. It's purely for educational purposes and definitely should not be considered financial advice. Please, always do your own research or talk to a qualified financial advisor before making any investment decisions.